Financing decisions made by creditors and investors are only as good as the information on which these decisions are based. As an analyst, you need to know and be confident in the process by which companies prepare their financial statements. Companies prepare financial statements through an ongoing accounting process shown here. Typically, this process begins with an analysis and recording of individual transactions and ends with the issuance of financial statements. The integrity of this process ensures the quality of the information in the financial statements. Please take a moment to review the 6 steps of this process.
The information contained in a company's financial statements is developed by aggregating the effects that individual transactions have on the company's financial position. Therefore, the starting point of the accounting process is transaction analysis. When an event occurs that has implications for a company, transaction analysis begins with the following question: what effect, if any, does this event have on the company's assets, liabilities, or shareholders' equity?
The arrangements of the accounts in the general ledger depicts the fundamental accounting equation, sometimes called the balance sheet equation. Assets equal liabilities plus shareholders' equity. This equation must hold at all times. The fundamental accounting equation indicates that the dollar amount of the company's assets must be equal to the dollar amount assigned to the company's liabilities plus the dollar amount assigned to the company's shareholders' equity.
Imagine that these stacks of money represent asset, liability, and shareholders' equity accounts measured in cash. Each stack of money represents a separate account. Transactions are the events that cause these stacks of money to increase or decrease in size. Activity, such as adding or subtracting money in one account, would have an equal impact on another account or accounts. An increase in one asset would cause either a corresponding increase in liabilities or shareholders' equity, or a decrease in another asset. A decrease in an asset would cause either a corresponding decrease in a liability or shareholders' equity, or an increase in another asset. Transaction analysis is very important because we need to correctly identify which accounts are affected by an event and accurately add or subtract from the appropriate accounts. Mistakes in transaction analysis lead to GIGO, garbage in, garbage out. Before electronic information processing, a manual journal entry, like this one, was made in a general journal to document the effects of each and every financial transaction. The important characteristics of a general journal entry are its date, the 2 or more accounts affected, the financial effect on each account, and a brief explanation of the transaction.
Today, journal entries are made using computerized accounting packages. However, completeness and accuracy on the part of those who analyze and input the journal entries still impacts the quality of the resulting financial statements.
After a period of time, such as a week, the general journal will contain many individual journal entries. When individual entries accumulate, a process known as posting is initiated. This process transfers information from individual journal entries to individual accounts in the general ledger. Now we will analyze 4 events in the first few days in the life of a newly formed corporation to illustrate how transaction analysis is done. First, a newly formed corporation has no assets, liabilities, and no shareholders' equity. So just before its inception, say on December 31st, 1994, the balance sheet equation would look like this. The corporation raises $100,000 by selling 10,000 shares. This transaction increases the corporation's assets by $100,000. We will create a separate account to reflect this. Secondly, the interest in this asset is known as contributed capital, a separate account within shareholders' equity. Now the balance sheet equation would look like this. After analyzing the effects of selling the shares and entering those effects onto the balance sheet, we can see that the balance sheet equation still holds. On January 4th, the corporation purchased $20,000 of inventory. Would this affect the company's assets, liabilities, or shareholders' equity? You are correct. The asset inventory increased, and the liability, accounts payable, also increased. How much did inventory and accounts payable increase? Correct. Inventory is recorded at its $20,000 cost, and accounts payable is recorded at $20,000, the amount necessary to satisfy the obligation. Analyze Event 2 and complete the fundamental accounting equation for 1995. Analyze Event number 3 and complete the fundamental accounting equation for January 6, 1995. Note that a new asset column for equipment has been added. Can you fill in the blanks below the fundamental accounting equation? What accounts would be affected by the activity described in Event 4? You are correct. Receipt of an order is an executing transaction. That is, neither the buyer nor the seller has performed its part of the transaction. Therefore, there are no asset changes, no liability changes, and no shareholders' equity changes. Note how many zeros there are. Accountants only record the increases and decreases to accounts. The zeros are used here to illustrate the fact that nothing has changed. Accountants often use a tool called a T account. Accountants record the increases in assets on the left side of the T account and decreases on the right. Liabilities and shareholders' equity increases on the right side and decreases on the left. It may seem complicated to record increases in assets differently than liabilities and shareholders' equity, but there is an internal check and balance built into this system. For now, remember that assets which are on the left side of the balance sheet equation increase on the left, and liabilities and shareholders' equity, which are on the right side of the balance sheet equation, increase on the right. To complicate this further, let's introduce some important accounting terminology. All transactions entered on the left side of the equation are called debits. All transactions entered on the right side are called credits. You are correct. You are correct. Let's consider the 4 events that occurred in early January for the newly formed corporation. The effects of the first 2 events have been entered into the T accounts. We have also added the beginning balances for each of the T accounts. Notice how the beginning balances are entered on the same side as the increases. Can you indicate where the effects of the 3rd event would go? Drag the number into place by clicking on the number and keeping the mouse button depressed until you move the number to where you want it to go. Since the 4th event did not affect any of the company's accounts, it does not enter into the T accounts. The effects of the transactions are added to or subtracted from the beginning balances to give the ending balances as of January 8, 1995. Suppose the company acquired equipment for $32,500 cash and the bookkeeper made this entry. Would debits equal credits? Good for you! You caught a transposition error. Would the balance sheet equation hold? You are correct. If debits do not equal credits, the balance sheet equation cannot hold. On July 13th, a company purchased land for $100,000 by paying $20,000 cash and taking out an $80,000 mortgage. The bookkeeper analyzed the transaction and made this journal entry. Right. $20,000 plus $80,000 equals $100,000. Was this transaction recorded correctly? Right. Land and inventory are different. When it is time to issue financial statements and all of the journal entries have been posted to the general ledger, an accountant prepares a trial balance. The trial balance is a listing of all the general ledger accounts with non-zero balances at a particular date. Traditionally, its purpose is twofold. First, to ensure that debits equal credits, and second, to prepare for the adjusting process. Today, the existence of software packages that do not allow the entry of transactions if debits do not equal credits renders the first purpose more or less obsolete.
Suppose that you just completed a trial balance, and it balances. That is, the debit column equals the credit column totals. Does this mean that all of the information is correct?
Correct. Although an unequal trial balance suggests that errors were made, entering transactions more than once or not at all would not affect the equality of debits and credits. Both would be equally too high or too low. Misclassifying a transaction would also not affect the equality of debits and credits. Yet the result is hardly correct. The unadjusted trial balance sets the stage for the adjusting process. The adjusting process culminates in the adjusted trial balance.
Once the adjusted trial balance is complete, the accountant can transfer the account balances to the appropriate financial statements.